Brent oil just exploded 3.7% after a missile hit a Saudi tanker near Yanbu. But here's what nobody's telling you. The NFP data drops in hours and it could send this market straight back to $79.50. I'm tracking two key levels, the $81.30 pivot and $83.72 resistance. My bias? The geopolitical risk premium is real, but demand destruction is lurking. Watch the full breakdown on Alpha Market Meridian for exact entry levels and my proprietary risk framework. And remember, this isn't financial advice. Trade smart. Welcome to Trade Meridian Decoded channel. I'm watching Brent crude hold above $82.96 after one of the most dramatic 24-hour reversals we've seen this year. Let me take you inside what just happened. At roughly 3:15 p.m. Riyadh time yesterday, a Houthi drone missile combination struck a Saudi commercial tanker approximately 40 nautical miles southwest of the Yanbu port facility. Let me tell you what Yanbu represents. This is Saudi Arabia's primary Red Sea export terminal, the alternative shipping route designed specifically to bypass the Strait of Hormuz constraints. And now that's under direct threat. What stands out to me is not the attack itself, but the market reaction. We saw a violent 3.73% spike from the session lows, adding nearly $3 per barrel to the price. But here's where it gets interesting. That move happened despite a surprise API crude stock build of 2.7 million barrels hitting the wires simultaneously. In my 20 years of trading, I have rarely seen such a clear demonstration of geopolitical premium overpowering fundamental supply data. This is the exact environment where emotion meets economics, and where institutional traders make their biggest mistakes. Today, I'm going to show you exactly how I am positioning across three distinct timeframes, why I believe the $79.50 level represents the most asymmetric risk-reward opportunity in oil right now, and most importantly, how the upcoming non-farm payrolls data could completely reshape this fragile narrative. If you are trading oil today, you cannot afford to ignore the structural tension I am about to lay out. Let us begin our technical analysis where I always start, the weekly time frame. This is where the structural story truly resides. Over the past 30 days, Brent has rallied an impressive 11.06%, establishing a firmly bullish monthly trend. However, the weekly chart tells a more complex story. We are currently down approximately 6.88% from the recent highs, tracking a corrective bearish phase that emerged from the liquidations we saw 2 weeks ago. This divergence between the monthly and weekly trends is exactly the kind of tension that creates violent swings. I have seen this exact divergence 3 times in my career. Twice it led to a violent reversal to the upside, once it led to a sustained breakdown. The differentiating factor this time appears to be the geopolitical catalyst, which I would argue gives us a higher probability of the upside scenario. The weekly candle structure is showing a large wick developing, which suggests buyers stepped in aggressively at the $79.50 level. I want you to note that this level coincides with the 200-day moving average at $85.40, which is above current price, but the psychological support at $79 represents the last line of defense for the bulls.my verdict this week is straightforward but carries significant nuance. I am neutral to cautiously bullish with a distinct bias toward fading any spike into the $83.72 resistance zone. The invalidation level for this view is a sustained break below $79 on a daily closing basis. If we see that, the entire geopolitical premium narrative collapses and we are looking at a potential freefall toward the $74 area that the EIA has been forecasting. However, based on current price action and the physical realities of Red Sea shipping, I believe the path of least resistance over the next 24 to 72 hours is upward. I will be looking to scale into long positions at the $81.30 pivot level and again at the $79.50 support zone, while maintaining short positions only at the extreme highs. This is a range-bound market with a bullish tilt, and I want to stress that the volatility we are seeing is not exaggerated. It is entirely appropriate given the geopolitical tension. My confidence level on this assessment is approximately 65%, which in my book means I am willing to commit capital but I am keeping position sizes at 60% of my usual allocation. The rest is held in cash, ready to deploy if we get a clear break of either key level. I want you to understand that this is not a market for heroics. It is a market for discipline and precise execution. Moving down to the daily time frame, we are seeing what I would describe as a neutral to rebounding environment. A strong bullish engulfing candle has emerged, driven entirely by the fundamental developments I mentioned. This is not a technical reversal in the purest sense. It is a fundamentally driven rebound that technicals are now confirming. The daily RSI at 44.50 is neutral, but I am observing a minor positive divergence on the smaller timeframes that I believe will translate to the daily if we get a follow-through day. The MACD at -0.785 is still bearish, but the histogram bars are shrinking and the signal line is flattening. This is the early stage of a potential bullish crossover. My interpretation of this daily structure is that we are in a wait-and-see mode. The daily close relative to the 50-day moving average at $84.65 will tell us whether this rebound has genuine legs. Below the daily pivot at $81.30, the bears remain in control. Now let us examine the 4-hour chart, which I consider the most actionable time frame for swing positions. Brent is currently trading strictly below the 50 EMA and a descending resistance line that has been in place since the July highs. The ADX at 22.40 is interesting here. This is showing a weakening bearish trend. Strength, which means the market is consolidating and potentially preparing for the next directional move. I have learned over the years that when ADX falls below 25 during a trend, you are entering a transition phase. The question becomes, which way does the transition resolve? The 4H pivot point sits at $81.30, and I consider this the most critical level for today's trading. A sustained break above $81.30 with strong volume would signal that the bears are exhausted and the bulls are ready to test the $83.72 resistance. A rejection at this level, particularly on the back of bearish NFP data, could send us back to the $79.50 support zone. The 4H CCI at -45.20 is recovering out of oversold territory, which supports the bull case but only if we hold above the pivot. Zooming into the 1-hour time frame, we see a bull rebound in progress. Intraday price action is testing local overhead moving averages, specifically the MA5 at $81.15 and MA10 at $81.80. The fact that price is now trading above these near-term moving averages is a positive sign for the bulls. The stochastic at 38.20 is showing a bullish crossover in progress, which gives me additional confidence in the short-term upside. However, I remain cautious because the Williams %R at -62.10 is neutral and not yet showing the kind of oversold momentum I typically look for in a sustained reversal. What I am watching most closely on the 1 hour is the behavior around the $81.30 level. If we get a clean break above this area with a corresponding increase in volume, I will interpret this as the final confirmation that the bulls have regained control of the intraday narrative. Conversely, a false break above this level, followed by a sharp rejection, would signal that the sellers are still active and we could see a retest of the $79.50 zone sooner than expected. I want to take a moment to discuss my proprietary volatility assessment model. Based on the ATR of 2.85, we are in a high intraday volatility environment. This means I'm scaling my position sizes down by approximately 30% compared to my usual allocation. When volatility expands, you have to adjust your risk parameters accordingly. This is not an opinion. It is a hard rule of capital preservation that has saved my account more times than I can count. The recent range expansion also means that stop losses need to be wider than normal to avoid getting stopped out by random noise. I have adjusted my typical 20 to 30 pip stop to a 40 to 50 pip stop for today's trades. Fundamental driver and calendar. News first structural emphasis. Let us anchor our analysis in the fundamental landscape because this is where the real story lives. The attack on the Saudi tanker near Yanbu represents a significant escalation in the Red Sea conflict. Yanbu is not just any port. It handles approximately 70% of Saudi Arabia's crude exports to Europe and the United States. The attempt by Iran and Oman to float a temporary shipping route bypassing the Strait of Hormuz was already a major story earlier this week. but the attack on the alternate route effectively dismantles that narrative. You cannot bypass the Strait of Hormuz if the Red Sea alternative is also under threat. This structural threat to alternate shipping pathways has instantly returned a risk premium of approximately $4 to $5 per barrel to global pricing. In my assessment, if this geopolitical tension persists through the weekend, we could see that premium expand to $7 or $8. The domestic supply picture adds an interesting counterweight to the geopolitical story. The API reported a surprise crude stock build of 2.7 million barrels, which temporarily capped the aggressive upside pushes we might otherwise have seen. This build suggests that despite the geopolitical drama, physical supply in the United States remains ample. The EIA data will be released on Wednesday next week, and I will be watching closely to see if the API build is confirmed. If we see a significant build in the official data, it could erode the geopolitical premium even as tensions escalate. This is the kind of crosscurrent that makes oil trading challenging but also incredibly rewarding for those who can navigate the complexity. Today's calendar is absolutely critical. We have the U.S. non-farm payrolls and unemployment rate scheduled for release. The market is expecting approximately 175,000 new jobs added, with the unemployment rate holding at 3.9%. A print below 150,000 would signal weakening economic conditions, potentially impacting global demand for crude and weighing on prices. A print above 200,000 would be interpreted as hawkish for the Federal Reserve, strengthening the dollar and also pressuring oil prices through the exchange rate channel. The ideal scenario for oil bulls would be a number between 150,000 and 175,000. Strong enough to avoid recession fears but weak enough to keep the Fed from tightening aggressively. It is a narrow path and I will be positioned accordingly. Later today, we also have the Baker Hughes oil rig count. This is a secondary event but one that I pay attention to for supply-side signals. A significant increase in rig count would suggest that U.S. producers are responding to higher prices, which could cap the upside in the medium term. A decrease or flat reading would support the bull case by suggesting supply constraints persist. Institutional sentiment remains fiercely divided. A July Reuters poll of 31 economists pushes a baseline 2026 average forecast of $85.22 per barrel. Enverus maintains an aggressive $100 per barrel estimate for the second half of 2026, citing prolonged choke point risks. Conversely, the EIA forecasts Brent falling towards $74 per barrel in the third quarter of 2026 as demand destruction in major importing hubs like China gains traction. I find these divergent outlooks fascinating because they reflect the fundamental uncertainty in the market. In my view, the truth lies somewhere in the middle. I am projecting a range of $78 to $88 over the next 3 months, with the actual price determined by geopolitical developments more than any other single factor. This is why I spend so much time analyzing news flow and positioning myself to react rather than predict. The OPEC Plus production quota update scheduled for next week add another layer of complexity. I expect the cartel to maintain current output levels given the price volatility we are experiencing. Any deviation from this expectation would be a major catalyst. I will dedicate a full segment to OPEC Plus in Sunday's weekly preview, so make sure you are subscribed and have the bell turned on if you want to catch that analysis. Now I am going to walk you through the 3 specific trades I am watching for today. Each setup includes exact entry levels, stop losses, and take profit targets. Setup 1. Scalp long from the pivot. The first setup is a scalp long at the $81.30 pivot zone. This is the 4-hour pivot level and I am looking for 15-minute bullish rejection candles to confirm entry. The trigger for this trade is price action on the 15-minute chart. I want to see a clean bounce off the $81.30 level with a 15-minute closing above the MA5 and increasing volume. The stop loss for this trade is at $80.80, which gives us a 50 pip risk. The take profit target is $82.50. Representing a 120 pip reward. This gives us a risk-reward ratio of approximately 2.4 to 1, which exceeds my minimum threshold of 2 to 1. The invalidation for this trade is a clear break below $80.80 with a corresponding volume spike. This would signal that the sellers have taken control and we should wait for better levels before entering. Setup 2. Scalp short at the resistance. The second setup is a scalp short at the $83.72 resistance level. This is the R1 level and I am looking for a failed retest with bearish price action. The trigger for this trade is price action at the resistance level. I want to see a clear rejection from $83.72 with a 15-minute closing below the resistance level and a bearish engulfing pattern. The stop loss is at $84.15, representing a 43 pip risk. The take profit target is $82.20, giving us a 152 pip reward. This produces a risk-reward ratio of approximately 3.5 to 1, which is highly favorable. The invalidation is a clean break above $84.15 with strong momentum. If we see this, I will look to flip long and target the $84.65 level setup 3. Swing long from support. The third setup is my preferred trade for today and represents the most asymmetric risk-reward opportunity. This is a swing long from the $79.50 support zone. I have limit orders layered between $79.50 and $80 to capture this entry zone. The trigger for this trade is price reaching the support zone. I want to see hourly candles showing bullish rejection signals and increasing volume. The stop loss is strictly at $78.50, which is just below the recent session low. This gives us a risk of approximately 100 to 150 pips depending on entry. The take profit targets are tiered, TP1 at $83.50 and TP2 at $84.65, which is the 50 EMA and major structural resistance wall. The risk-reward ratio for TP1 is approximately 3 to 1, while TP2 offers more than 5 to 1. The invalidation is a break below $78.50 on a daily closing basis. If this happens, the technical narrative shifts back toward the EIA's structural sub-$80 targets. Between these setups, I want to emphasize something important about my approach to trade execution. I never commit my full position size at a single level. For the swing long, I will allocate 40% at $80, another 30% at $79.75, and the final 30% at $79.50. This laddered approach allows me to average into the position while maintaining discipline on my stop loss. It also reduces the risk of getting stopped out by a single spike. I learned this technique from a mentor early in my career, and it has saved me countless times. If you do nothing else from this video, adopt this laddered approach to your trades. I want to take 30 seconds to discuss risk management because this is where most retail traders fail. My personal rule is never to risk more than 2% of my account on any single trade. For the swing long, I will risk 1.5% because of the elevated volatility. For the scalp trades, I will risk 0.5% each. This means that even if all 3 trades hit their stops, I would be down only 2.5% of my account. I can recover from that in a single good trade. I have seen traders blow up their accounts in this type of market because they get overconfident and over-leverage. Let me share a personal anecdote that has shaped my risk management philosophy forever. In August 2022, I watched a similar oil setup unfold and I got greedy. I added to my position 3 times without adjusting my stop loss. The market reversed violently and I gave back 60% of my quarterly profits in 2 hours. That experience taught me that discipline is not optional. It is the only thing that separates surviving traders from those who don't. Today, if any of my stops hit, I